with random acts, and especially as far as tax is concerned. But let me take a break on India and talk to you about China and ask you what your sense is about China. You say China is not so calm anymore. We've seen the Chinese central bank go in for a third rate cut less than 6 months. Do you believe that that is largely responsible for driving the equity market rally?
Right, so Chinese markets have diverged massively from both monetary policy as well as the economy. The economy is growing about maybe 6% real, about 5.5% nominal, and so it was growing about 20% nominal before the crisis. So the growth rates really have decelerated, and there's nothing wrong with that. That's just the way they're getting older. You know, they've already had a huge capex boom. So equity markets can normally respond to very aggressive monetary easing. And my view is that actually China has tightened policy. I know it seems like it's eased, but actually if you look at loan growth, if you look at real interest rates, so interest rates minus inflation, these things are a lot tighter today than they were 6 months ago. So if you just look at, oh, they've cut rates and they've cut the RRR, that to me is an illusion, right? So because you're looking at nominal terms. I think policy is actually quite tight. The market obviously has done exceptionally well, and so it is anticipating a humongous easing of policy. And it's actually a reasonably rational market in the past, that when policies ease, it's done well, and vice versa. This time around, however, there's a massive chasm that's opened up between how tight policy is and where the equity market is. So the Chinese central bank had better deliver on these massive expectations.
And if it doesn't?
Well, if it doesn't, then I think the market is quite vulnerable.
What kind of downside risk would you say?
Well, markets double, so I think we really need to see some very severe, serious interest rate cuts for it to sustain itself.
And this business about a QE kind of stimulus being provided by the Chinese central bank, we don't know what shape, form or size it could take. What are your expectations, and what could then that do as far as the equity market rally is concerned?
Well, the Chinese central bank has said pretty categorically that they're not into QE, and they don't need to, because the policy rate is 5.1%, so they can take it all the way to 0. You know, the RRR is about 18%, they can take it down to 7 or 8. So there really is no need for QE. I guess the need for QE occurs when you get into a liquidity trap where, despite cutting interest rates and RRRs, if no one borrows money, well, then the central bank and the government's balance sheet need to come into play. But I think we're quite far from that.
But even in terms of corporate earnings and in terms of leverage, you know, some of the common factors that both the Chinese side as well as India is suffering from today. And do you anticipate a revival as far as both corporate earnings as well as consumption in China is concerned?
No and no. So Chinese debt, leverage, is a massive number. It's about 290% of GDP. It's higher than the U.S. India doesn't come close. So India is a very under-leveraged country, except for the government.
In comparison, yes.
Right, in comparison. The Indian government has a high leverage number. The Chinese government has about 55%. India is higher. But the Indian household sector, and except for those 10 or 12 companies that we talked about, the corporate leverage really isn't that high. And neither is financial leverage. So I think they're two completely different beasts. What was the follow-up to that?
So when do you anticipate a pickup as far as the earnings in China are concerned?
Well, the nominal growth numbers, as I said, have gone from 20% in 06 to about 5.5%, and they are going to go lower, highly likely. So you're going to get very little top-line growth. There's a lot of pressure on margins through high land costs, high labor costs, and a very strong currency. So I think getting profit growth is going to be exceptionally difficult. Now, there are certain sectors, the new growthy areas like technology, the internet, healthcare, education, vanity. You know, these sectors, I think, will be growing earnings quite substantially, but they're not that large, except for technology. So the sources of earnings growth are going to be quite different going forward. And
yet you see a significant amount of money going into China.
Well, a lot of money is going to China really because people are very underweight. And so while the A-share markets were rallying, foreign investors really couldn't be bothered because it wasn't really in their benchmarks. It's only when some of the local domestic Chinese money percolated into Hong Kong equities, which are in the benchmark where our clients were underweight, that all of a sudden they had to chase this rally.
Going back to India, news talked about the governor. What's the outlook as far as interest rates are concerned? Do you believe that the central bank has wiggle room to do anything more than 25 for the year, or do you believe that 25 is perhaps the best that we could possibly see in terms of rates?
Well, I don't know if it's 25 or 50, and I'm not an economist, but I think that I'm sure Raghu is obviously looking at where the monsoon goes and where oil prices go and obviously where inflation goes. I think there's enough slack in the Indian economy. I mean, it's quite shocking that PPI is negative and CPI is about 4 to 5%. These are pretty low numbers. And as you pointed out, that the private sector capex demand is very weak. And so I think you need to kind of get the animal spirits of that economy going, and I think there's probably more scope for interest rate cuts.
But if we don't see actual aggressive intervention from the central bank, do you believe that the earnings recovery will be pushed back even further?
Yes, because real rates are on the higher side in India, because inflation has just collapsed, and nominal rates really haven't. So you do have a part of the corporate sector that is levered up, and so high real rates are obviously problematic. And also for the consumer cycle, higher real rates are an issue for property buying and for auto purchases.
So at this point in time, given the fact that we've already seen a correction of about 10% as far as the Nifty is concerned, and you believe that this could be perhaps an opportunity to allocate more capital to India, what kind of upsides do you see, at least in the near term? Perhaps by the end of the year, what kind of upside are we looking at as far as Indian equities are concerned?
Well, I think the multiple is probably fair. It's about 15 to 16 times forward. I think the earnings numbers, that they grow about 10, 15, that's probably what you should look for.
Do you think there's a downside risk to the 10 to 15% number?
Quite possibly, yes. Because
how much lower could it be?
Again, I don't really know what the specifics are. I think if you want to look at India, I'd urge you not to look at this on a monthly basis, although I know that's what you need to do. You got to look at it as a 5-year story, because the Indian earnings numbers we think can compound about 20% per annum. They said that the economy probably should grow at trend by about 9% or so. I think that the EBITDA margin should go from about 16 to about 19 to 20%, which is a long-term average. And if you get those two things, well, then your earnings compound 20% per year, which means it almost double in about 4 or 5 years. So keeping the same multiple, 15, 16, you should double your money. So what I tell my clients is don't look at India too deeply, because A, you're going to get disappointed and frustrated and surprised, and B, you'll sell and then you'll regret it. So sometimes being lazy is a better option than being hyperkinetic.
Right. So being lazy is a better option at this point in time. But in terms of reforms and in terms of policy action, because you believe that India is a 5-year story, it's not a 12-month story, what more would investors like to see? We've seen further liberalization, whether it's defense. We've seen the government make efforts to provide a better business environment, ease of doing business, make in India, and so on and so forth. In terms of actual reforms, what is it that investors are looking for?
I think they're looking for a better investment climate where you can get access to land, when you get access to power, water.
So it's the infrastructure deficits.
Well, it's all the factors of production. Land is not per se infrastructure. You just need to be able to get it. You need power for sure. There's enough coal in India. It needs to be dug out and then, more importantly, transported properly. You do need a workforce that is quite trained and educated. And I think that is going to be a challenge.
So we do have the demographic advantage, but not necessarily the skilled people that we need to add to the workforce.
That's right, yes.
On the infrastructure side, we've seen this government allocate substantial amounts of money, whether it's the road sector or the railway sector. They're also talking about attracting foreign investment into both roads as well as railways. How excited are you about the government spending on infrastructure and about these two stories in specific?
I'm super excited by it, if it happens.
Yeah, because the track record is poor, especially as far as roads are concerned.
It's below average. But it can get better.
You're being kinder.
Yes. Because I've seen what it's done in China. Well, they've gone from a pretty low level of railroad intensity to one of the world's biggest, most modern railway networks. And likewise for roads. So they've been added for about 15 years, and they have accomplished it. They've kind of done it. There's a little bit left on the sides. And so I think India should really engage with China and import its expertise in these two areas.
See, the infrastructure story is being particularly exciting from a Chinese investment point of view, because look at what they're doing with Pakistan, the Pakistan-China Economic Corridor. $46 billion. Of course, it has India worried at this point in time, but do you see significant engagement between the two countries as far as infrastructure is concerned?
Yeah, if India wants it, absolutely.
Yeah, feasibility studies on for the bullet train. You know, China is doing that at this point, but do you see that moving beyond?
Well, I think it depends on Indian policy makers whether they actually want this or not. Because China is a low-cost, efficient provider of infrastructure services to the developing world.
Yeah.
So China is going to industrialize the developing world. You want turbines, you want machinery, you want a power plant, they can do it for you at a cheap price point and do it efficiently. So the ball is really in India's court, whether India wants this at a cheap price point or not.
Let me get back and end with India, because you said that it's a 5-year story and one shouldn't judge it every month or every quarter, perhaps even every year. But specifically, if I were to narrow you down to 2015, because we've had a great year as far as the equity markets are concerned in 2014, up almost 30%, up 16% post the electoral results. How much upside do you believe in 2015 the Indian markets could enjoy?
I think we could see about 15% or so from here, which is
from these levels?
Yeah, which is primarily earnings growth and a little bit of multiple expansion.
Well, on that note, it's always a pleasure speaking with you. Thanks very much for joining us on the Asian Tigers, and thank you very much for your time.
Thank you, Shereen.
Well, on that note, it's time for us to wrap up the Asian Tigers for this week. We'll see you again next week. Till then, from the entire team, goodbye and many thanks for watching.